The moment you deposit money into your bank account, you stop being its owner. This is not a metaphor. This is the law. The second your paycheck hits your checking account, that money legally becomes the property of the bank. What you receive in return is not your money. It is a promise. A promise that the bank will give you back an equivalent amount whenever you ask for it. You have become an unsecured creditor of a financial institution. And most people have absolutely no idea what this means or what happened. So, where does your money actually go? The money is more unsettling than most people
Huh?
are prepared for,
Mm-hmm.
and understanding it will change the way you think about every dollar you have ever deposited. Here's what happens in the first few seconds after you deposit. Your bank takes the money and splits it. A small percentage, determined by something called the reserve requirement, gets set aside. For most of modern day banking history,
Mm-hmm.
that number has been around 10%, meaning for every 1,000 you deposited, the bank was required to keep 100 on hand. They dropped the reserve requirement to zero, not 5%, not 2%, zero. American banks are now legally required to keep none of your deposits on hand. Every single dollar you deposit can be lent out, invested, or used however the bank sees fit. This is called fractional reserve banking. This is the engine that drives the modern day financial system. Here's how it actually works in practice. Let's say you deposit 1,000. The bank lends 900 of it to someone else. That person deposits their $900 loan into their bank account. Their bank now lends out 810 of that, and so on and so on. By the time this chain reaches its mathematical end, your original 1,000 deposit has
Huh?
theoretically enabled the creation of up to 10,000 in loans across the banking system. Your 1,000 became 10,000, not for you, for the bank. And what do banks do with all this newly created lending capacity? They charge interest on it. They lend it out as
Hmm.
mortgages at 7%, car loans at 9%, credit cards at 24%, personal loans at 12%. Every one of these products is built on the foundation of your deposited money. The bank is renting out your savings to other people and keeping the profit. What do you get in return? If you have a standard savings account right now, you are likely earning somewhere between 0.01 and 0.5% interest annually. The bank is charging borrowers 7 to 24% and paying you 0.01%. The spread between these two numbers is the business model of every retail bank on earth, but it goes further than lending. Banks do not just lend your money, they invest it. Commercial banks hold massive portfolios of government bonds, mortgage backed securities, corporate bonds, and other financial institutions and instruments. They have used deposits as the raw material for investment strategies that generate returns far beyond what any savings account will ever offer you. Remember 2008? Yeah, when the housing market collapsed and banks around the world nearly failed overnight. That happened because banks have taken depositor money and invested in mortgage backed securities, bundles of home loans repackaged as investment. When these loans went bad, the investment went bad, and the money that depositor thought was sitting safely in their accounts had actually been wagered on the American housing market. The banks lost. The depositor almost lost everything. The government stepped in with $700 billion in taxpayer money to prevent a complete collapse of the system. Your deposits are not sitting in a vault. They never were. Now, here's the part that should make you think differently about your financial decisions. The bank is using your money to generate returns of 7, 10, 15, sometimes even 20% or more, and they're paying out 0.01% for the privilege of using it.
Hmm.
This is not a conspiracy, it is just business. But it is a business that only works if you do not understand it. The moment you understand it, the question changes. The question is no longer, how do I save more money in my bank account? The question is, how do I stop being the raw material and start being the investor? Because the strategies banks use to generate returns on your deposits are not secret. They are not locked behind doors. Index funds, bond portfolios, real estate investment trusts, dividend paying stocks, these are the same categories of assets that banks use to grow depositor money into institutional wealth. The difference is that when you invest directly, you keep the returns instead of receiving 0.01%, while the bank keeps the rest. High yield savings accounts are a start. Some online banks are currently offering 4 to 5% annually, far better than traditional savings account, though still below what the bank earns on that same money. Treasury bills, money market funds, and short-term bond funds offer similar or better rates with comparable safety. For money you will not need for 5 years or more, the historical average return of a broad stock market index fund has been approximately 7 to 10% annually over long periods. That is the range where banks operate. That is the range that is available to you. Your bank is not your financial partner. It is your financial customer. It is borrowing your money at 0.01% and reselling it at 10 times that rate. The moment you deposit your paycheck this morning, the bank went to work with your money. The question is whether you are going to do the same.